Awesome. Welcome, everyone. Thanks for joining us today. We're really excited to have you all here. And we're even more excited to have the amazing Emily Rich and the good one, Alan Jones, here with us to chat about Mate Ventures. First of all, my name is Cheryl. I am the founder and CEO of Aussie Angels. We're a platform that supports investors who run their own angel syndicates and micro funds. And the syndicate we're going to be talking to today is Mate Ventures. So I'm very excited to bring both Emily and Alan on board. I've known both of them for a very long time, probably from like the very first time I landed in Sydney about 8, 9 years ago and was running StartCon back in the day. And these two were running around, I think you were at Microsoft before that, Emily, and Alan, you've just always been this investors. I kind of had this constant presence in my life from before I was an investor. So first, I'd love to get to know you both. Maybe you could talk a little bit about your background and how you got into this. Alan, let's start with you.
Okay, let's start with me. I got into the tech industry by reporting on it so long ago that we didn't have the web back then, but we had lots of organizations that were buying personal computers for employees for the first time. And so if you were the person who had to choose what sort of computer to buy, you had to read a computer magazine. So I was the editor of a computer magazine when we learned about the computer industry, and weird, right? But then when I saw the beginnings of online media and the start of the web, I thought, oh no, this is probably going to kick the guts out of the magazine industry. And the first generation of online media startups were basically online magazines, right? So I had a lot of transferable skills, so I made the jump. I spent a brief time at Microsoft working on some of the things that later became part of 9MSN. But Microsoft wasn't really a startup, and I thought I might be a startup person. So I took what I thought was a huge risk and joined a little startup that most people never heard of at that time. And that was Yahoo. So kind of by accident, I became employee number 118 of Yahoo, and it started in a product role and ended up as the product director for APAC. When I left Yahoo in 2002, I started working on my own startup ideas and working with co-founders and things, generally as a head of product. And by the time I got into middle age, I realized that I was probably going to have to figure out how to have multiple eggs in the basket at one time. And so I started to learn how to be an angel investor, and mostly by hanging around and getting involved with accelerator programs, because at those stages, people need as much advice as they need capital. And so if you're not too confident with investing in people's companies, you can at least see if you can give them some commercially useful advice. So that's where I began, and that's how I became an investor, I guess.
Awesome. And Emily, tell us a bit more about your background experience.
All right. So my how I sort of got into all of this and how I got to where we are sitting right now is I have a technical background. So I started at uni, computer science, did the very cliche, dropped out because I wanted to run a startup. And that's sort of how everything started for me was as soon as I dropped out of university and was running my startup, ran that for 5 years. That was an AI ML based company and sold into a ton of really different size companies, but particularly some quite large ones that we would know, like Unilever and YouTube, etc. So having had that experience and then selling, so 5 years later sold that and then wanted to start working with startups. I loved mentoring startups. The very first mentoring that I sort of did was when I was still running my startup, and I loved it. And I loved helping out founders. And then when I had the ability myself to then I had some money and I was able to invest, I started angel investing, and that's what sort of brought me into the investment community. And then from there, I most recently was running Microsoft for Startups for APAC, and did that for 5 years. And I left there towards August last year to work full-time on investing. So work full-time with Moat Ventures and invest full-time, and whatever that sort of looked like in various, sort of shapes and forms, which we can go through as well, I'm sure. But that's basically how this all transpired for me and how we're here today. So there you go.
Awesome. Alan, Emily talked a little bit about loving that mentoring piece and that's why she got into this space. What's your why for angel investing and early stage investing?
So a lot of the time, in a perfect world, if I had, another 30, 40 years, I love being part of startup teams. And I guess being an investor in startups allows me to have one foot or a couple of toes or a heel or something still in an early stage startup team. And the opportunity to work with founders is one that I take very, very seriously. So I haven't been involved with accelerator programs since about 2010. When there's just been a cohort come through, say for instance the StartMate cohort last week, a demo day there. Everybody's question is, so who are your favorite startups? And I really mean it when I say, look, as a mentor in an accelerator program, it's my responsibility not to have favorites, right? I'm there to help all the companies in the cohort succeed as best I can. Some of those people will take my advice, some won't. Some of the time I'll be wrong with my advice, and I actually really love it when a founder is able to come back to me in the future and say, hey, you gave me this advice, and look, turns out you were wrong and my idea worked. I love that because all of these things give me an opportunity to learn from the companies that I'm working with, and no longer being in a position to be a startup founder myself. The learning journey, the opportunity to have a few toes in a startup and learn from that experience, I think is really the why for me. At Main Ventures, we have a couple of really important investment lenses, filters that we apply to the startups that we look at to help us choose, between all the great companies that we could invest in to those that we do invest in. And those filters are very important to Emily and I as well. So when a company passes through that set of filters, I feel like we're values aligned, not just into this as an opportunity to make money together. This is actually about, we talk about, obviously we don't want to invest in things that make the world a worse place, but neither do we want to invest in things that pretty much just leave the world about how they are right now. Just shuffling the money around from one set of wealthy people with privilege to another set of wealthy people with privilege, right? So we're kind of looking for opportunities to invest in things that make the world a measurably better place. And so a lot of our filters come from that as well.
And we will absolutely get into some of those filters, but maybe first you could, whether Emily or Alan, touch on why start a syndicate? Why this for you, and what's the purpose here?
Yeah, I was just talking about this about an hour ago in another meeting that we had, so I can probably just give some. Yeah, I could probably shed some light on the why. And for us, we publicly stopped raising during COVID, as well as a lot of people, if you've been following our journey, would know. And that, so I think I should probably start there. Is like, we started raising, we stopped raising in COVID for a very good reason, and that being that the climate, a number of our investors were really worried about another GFC, and we're really pulling back from investing. And also, we know the public markets crashed. We saw all sorts of things, commercial real estate go down. The types of investors that we had on our books were all invested in those things as well. So very, very difficult time for them. a lot more pressure to then for them to then commit money to something else when there's a lot of things going on in the world. So we made that decision to press pause. We continued angel investing ourselves. And so we were investing together still. And then we took that off pause, came back, started raising again. Macroeconomic situations still not quite where it should be. And we are still seeing, there to be a sort of struggle in that funding landscape in quite a few places. And then what we wanted to do, we didn't want to stay out of the market. We were seeing so many good deals, and that's the thing where, we're so ingrained in the market that we're seeing so many things all the time. And because we're on the ground, we were also missing out on a lot of things that we would have loved to have gotten into early. And that's another thing. We go in quite early. I saw a question just before which touched on that. So I'm interested to get to that. But the purpose for the syndicate is twofold. So we were always building a syndicate alongside the main fund. The reason being that our minimum check size in the fund was quite large for, it just it was not a one size fits all sort of check size. It was like, you have to have a lot of money check size. And what we're trying to do, and coming back to some of those filters, what we're trying to do is actually make it a little bit more of a level playing field for people to actually be able to make money as an LP and actually get into to be able to invest is such a privilege. And it's a privilege that a lot of people actually don't get I didn't have the ability when I wanted to go into Blackbird Fund 1, for example. I didn't have the money. I didn't have that at the time. So for me, I look at that and I go, oh, I would have loved to have done this, and this, but I didn't have the money for it. And there was no other option for me. And so now obviously that's changing. And what we want to do is make sure that we have a diverse network of LPs. So it's not the same people over and over and over again making money, as Alan just touched on before. That brings diversity of thought to our portfolio as well, because a number of our LPs are also very strong mentors in this space. So in whatever space they're in. So we have a lot of product people, we have a lot of tech people currently in the network. And this is why it's so important that we make sure that having a syndicate for us was sort of top of mind, being able to be in market and not having to sort of worry about raising a giant fund and being out of the market when we're just seeing so many good things, and we just want to be active in the space, and we want to contribute. And for all the reasons that Alan said, and my reasons as well are, I love helping founders. I didn't have the best founder journey with my investors. I want to be the polar opposite. And so there are certain things that drive us, I suppose, and we want to be in market. And so the syndicate and working with Aussie Angels just means we can do that. We can be in market straight away.
Yeah.
Amazing.
Yeah.
Little plug for Aussie Angels there.
Yeah, there you go. And that was a very long-winded response, but
I know. I'm just going to add the two just personal things to that. Excellent answer. And one is, you and I, Cheryl, have known each other for a very long time. I was very fortunate to have a little bit of money to be able to actually participate and invest in Aussie Angels itself. Last time we raised, and I hope we're able to follow on that. And since I've been paying attention to Aussie Angels, we've seen the product that you've been building grow and add features and functionality and get closer and closer to being a great a solution set for the two sides of your marketplace. So one of my very old friends and a head of product that I hugely admire came on and joined the Aussie Angels team, Vinko Grigic. who I've known since he was a first-time startup founder. And so, I really feel like there's a bit of a people's revolution, a movement behind the momentum in Aussie Angels, and that very much is a good value fit for Emily and myself.
Cool. Well, I did not plant that. But one of the things that Emily mentioned was that the two of you have been angel investing for forever, but more recently as well in this kind of exciting market. I'm curious, what are some of those deals in your portfolio, and how did you get access?
Alan, do you want to start?
There?
You have about 7,000 investments, so we might be here all day and spend.
I just got a very small secondary exit from an investment I was able to make in Canva. I don't know if you guys read about some of that, and so I've made a couple of investments just in the last week, which is exciting. But I basically, as an product person, I started out investing in startups that were building products that product and software engineering teams could use. So my first independent angel investment in something was a product called Bugherd, which is a successful company, 20 or so employees, doing a few million in turnover every year. It didn't turn out to be something that would deliver venture scale returns for its investors, but the company had enough cash flow to buy us all back when that became apparent. And Alan Downey down in Melbourne is now working on a game studio and launching his first game. So the product that they initially launched was an issue and bug tracking tool called Bugherd. It's still out there, still recommended if you particularly need feedback from clients. So I invested in a bunch of things that I would use as a product manager, and I think that's a good place for a lot of people to start. And then gradually, as it looked like I wasn't failing, and I gained confidence and saw some track record under the bridge, and started investing in other things that I was interested in. Everything from music, because I used to be in the music industry for a little bit, through to two-sided marketplaces, because some of the products I worked on had been two-sided marketplaces. So one of the great things about an angel investor, I think, versus being a VC is when you're a VC, you have to you come up with an investment hypothesis. You attract investors who are interested in that investment hypothesis, and then for the next 10 years, you've got to invest in that investment hypothesis. So, and what might happen is that the market might move, the industry might change, the world changes, and you're stuck with a 10-year investment hypothesis, which perhaps isn't as good a fit for purpose as it was when you started. An advantage for all of us as angel investors is that we're accountable to ourselves and perhaps our significant life partners and our kids. Well, we don't want to spend all of their inheritance. So I think there's a huge advantage for someone who's getting started in angel investing to think about, well, where do I want to begin? What do I think I know about, and what do I think do I care about? But then, how can I explore? Because with exploration comes the opportunity to be flexible and to change with the market. And also with exploration comes obviously learning, right? So I often like to say that to first-time angel investors, until you write your first check, you haven't learned anything, right? Until you've got skin in the game, you're not really learning any of the lessons. You can read a lot of blog posts, you can listen to a lot of podcasts, but until your money's on the table, you're not really learning. So my advice to most people is to get started with something you think you understand, with other people who you think you understand, and go from there.
Awesome. And maybe this leads into one of the questions that's been submitted in the chat here. In your experience, what are some of the key traits or indicators that successful angel investors possess, and how do those traits differentiate them from less successful investors?
You can't be a dickhead. And that's
we wouldn't be friends if you were a dickhead, Alan.
No, but when you're evaluating startups, right? So when I've had opportunities in the past to invest in companies that were led by people who I was pretty sure were dickheads, but provided there was a significant financial incentive to invest in the company. I thought they'd make me money, And what I failed to appreciate is that, angel investors really do need to come with their knowledge and their experience and their network, and not just their capital, right? And so 8:30 p.m. on a Sunday night and my phone goes buzz, and I've got a text from a founder saying, I'm nervous about this meeting I've got tomorrow morning. I'm sorry to text you on a Sunday night, but like if you had a couple of minutes, if we could just talk through what I've got to cover with them tomorrow, I'd really appreciate it. I have a choice there. Can I say to my forever girlfriend, Kath, could we just pause Netflix for a minute while I just take this call? Or do I pretend I didn't see the text message, right? So for people I really care about, people who I really want to succeed, people I have a really good mix with, I'm going to take that call. I'm going to apologize to Kath and go and take that call. For somebody who I don't really like, but I think that they might make me money one day, I'm probably not going to try as hard, right? Every time you ask me to introduce you to somebody influential that I know, I take on a reputational risk. And if you're a dickhead to some degree or 100% dickhead, I would be more reluctant to do that. So if you multiply all those different opportunities for me as an angel investor to help, if you multiply that, if you're helping good people, you're going to help a lot more. You ought to see a better return on investment from that. And unfortunately, dickheads do still sometimes prosper, but not without help. And that's kind of, if I can touch it, that's where our name comes from, right? So the letter M in the numeral 8 is just shorthand for mate. What we're aiming to do is try and build two awesome communities that help each other out. So one really great little community of angel investors who lean in and help, and one really great community of awesome startup founders that we want to lean in and help as an angel investor community.
Amazing. I love those traits. Don't be a dickhead. Definitely no one in this room.
Yeah.
No, you can't help it. If you're a dickhead, you can't help it. There's no saving you. But don't invest in dickheads.
But it's definitely also, I think, just from my perspective as well, I think successful angel investor, and I touched a little bit on the I didn't have a good experience, right? So I have a personal experience that I didn't have a good experience with. And so I basically do the opposite of that. And it's what that looks like is what we've been talking about, is it's not just about money. It's also the expertise, the experience you bring, and really understanding the founder journey, having empathy. Those are all traits that you really need to be successful as an angel investor, or even as an LP in a syndicate or a fund. You need to understand that if you're someone who's really, really used to investing in companies that operate off a balance sheet that's always in the green, and then you start investing in startups and you realize they're always in the red, that's a very jarring experience for someone who doesn't quite understand that's how it works. That's how like the growth trajectory kind of works. And that understanding and that empathy is what you sort of have to bring as well.
Yeah, I hear that term empathy a lot, I think, from an investor perspective. Like if you don't have empathy, it's going to be really hard to understand your founder, but also to understand the customers who your founder's particularly serving. All right, let's jump over to those filters that you've talked about. I'd like to hear a bit more about your thesis for the syndicate. What types of what do you look for in founders, and what are those filters that you talked about?
There's a common a pattern in a generation of Australian startups kind of over the past 20 years, where you meet someone who's the founder of a startup, they're a founder for the first time because they've come from an industry and they've decided to set out to solve a problem for that industry. So you've had a 20-year career as a lawyer, and there's been a problem and you've come up with an idea to solve that problem using tech. And so you set out, you leave the legal profession, you become a startup founder. And your first challenge is that in order to build some software, if it's legal, it's almost certainly software, you need to make friends with somebody who can code. And you probably don't know anybody, and you probably don't have time to teach yourself. So it's a very common pattern for us to meet a great founder with a really good lived experience of the problem, but they'll openly say to us, I'm not a tech person myself, but I've outsourced the build to this startup studio, or I've outsourced the build to an offshore team, or my My cousin, my 22-year-old cousin writes code, and so he's building the MVP for me. And sometimes those businesses will succeed, but as investors, our job is to look at the odds and form an opinion on the likelihood of that success. And we like to look for a different kind of startup. We like to look for a startup where understanding how difficult it is to build a world-class technology product is kind of at the heart of the foundation of the business. We like to see product and engineering represented in the leadership team of the company, rather than being a bunch of email addresses and WhatsApp numbers originating in southern India or Estonia or somewhere. Like, it's possible to make some progress that way, but if I was starting out, I wouldn't recommend that. Having been on teams that have built world-class technology products, we appreciate how hard that is to pull off, especially coming from a market like Australia, where people with experience and with skills and with qualifications are, relatively speaking, rare. But an advantage that we have as startup investors is having that kind of background ourselves. We think we're better at evaluating the potential of the product and engineering teams within startups than many of the other investors out there in startup land. So building world-class technology products is what excites us. And it's also what we think we're better at evaluating. If a team is successful building a world-class technology product, then they're investing in a defensible moat. If you haven't heard that term before, a defensible moat is something which is difficult for your competitors to cross. So if you look at most sectors in technology, the company that's least likely to be disrupted by its competitors is that one that has a technology product that customers love more than its competitors. It's very hard to beat customer love at the end of the day. So that's one of the things that we really look for. I also spoke about how we're not content with investing in things that make the world actively worse. Neither are we interested in things that leave the world pretty much the same, but just move money around from one set of people to another people. We really are trying to look for things that are making the world measurably a better place. And so some of our filters are around that. So we don't invest in defense tech, for instance. We don't invest in things that are relying on
that as well, by the way, for anyone who
yeah. That was
popped our screening there so everyone could see it. We're not gay.
So this is it. Yeah, this is in our standard deal note that we write up on all the deals we look at. And we just sent through one today to another potential investor. And so addictive gamification is a really interesting area. A lot of us are parents, and you'll know that a lot of software designed for kids is designed to get them to come and pester you, so you can punch in your credit card details and they get some meanings little trinket. It's not just a game to keep them entertained. That is the same addictive pathway as the kind of thing that keeps an adult addicted to a poker machine. So we really can't be backing teams that are building that kind of crap for kids. And another really important lens for us is diversity. I really want to touch on that, because the data shows to us investors that more diverse teams outperform less diverse teams. So just from an investment perspective, it just makes sense to back diversification in companies, like truly inclusive, diverse teams. And the sad thing about the history of the tech startup industry is we've kind of postponed diversity until later. We've got lots of really big, immediate, urgent problems to fix. Diversity would be nice to have. We'll do it later when we have a bit more breathing room. The problem with that, really, is that if you've got a few hundred employees, you get to the point where, what are we doing? Like, we're getting worse and worse on diversity. None of our job applicants are diverse candidates. And that's probably because you have all these unconscious cultural biases around your organization. You don't appear to be a place where diversity is celebrated. And you have to learn a whole new language. And then those few people that join you from a diverse background feel like, they're the first antelopes stepping into a paddock full of lions. They don't see people like themselves represented in the rest of the organization. And so they're reluctant to speak up. They're reluctant to give fully of themselves because they don't yet feel like they're part of the family. So how we intend to work with the startups in our portfolio is to start with diversity at the top. Now, we start investing if we can as early as possible. And then one of the nice things about investing in companies at that stage is they often don't have a board. It'll be founders and then team members, right? So above founders, ordinarily, there is a board. So sometimes companies will need help appointing an advisory board, and sometimes investors in the round alongside us, or perhaps us, will help that startup form a board. And so we think if we can help the startup begin with a diverse board, then we can help them build a more diverse leadership team, because usually founders at this stage are wearing multiple hats. And some of those hats will need to be filled by other members of the leadership team with capital from us and from other investors. So we want to help our companies build out those missing roles in the leadership team with diverse candidates. So we have diverse representation in leadership, diverse representation on the board. And that really solves the problem of adding diversity to the rest of the organization. Again, makes the world a better place, but also delivers us a more likelihood of a better investment return.
And John just asked, I could probably answer this, John, because it's what we are dealing with a lot, because we deal with small teams a lot. But John's just asked, how can a very small team of 1 or 2 show or indicate positive diversity traits? So it's a lot about what Alan just spoke about. For companies that we've invested in and we've put a term sheet together, we have a diversity mandate, which means they have to make an immediate change, essentially. And that can look very different depending on what the company looks like. If you're a company of 1 person or 2 people, yes, it's how do you show that? It's with your, as Alan just said, it's with your board. It's starting that board appointment. It's starting those things. And then we work with the team on ensuring that leadership positions, so C-suite positions, decision-making positions, are out there for diverse candidates. So that's where we're sort of looking at making advising those changes happen. And then of course there's the mandate wrapped up in everything that we do as well, because as we've said, the teams outperform. And Shailen, the definition of diversity is not only gender. No, it's we look far beyond that. We are looking at every underserved community. So that can be absolutely, everything. So we're definitely,
we stack rank diversity, right? So statistically, gender diversity is the most represented form of diversity, right? So let's start there. 50% of the population aren't male. And then let's move on to each layer of diversity according to its representation in the general population. Let's create companies that reflect the communities that they serve. That's the real outcome. This is a collaborative process and an ongoing process, right? And we don't want to just set, here's what we expect of you, now go do it. We want to be part of helping make that happen.
Yeah, it's about building a product for everyone, right? At the end of the day, we've seen all the, I'm sure that people have seen the news articles when they eventually come out on products that big company X has built and it's failed for a large area of the population, or it could be anything, right? And that's what we want to avoid from the very beginning. So it's very important to us as early stage investors that we make sure that diversity is starting from day one. And then it's just commonplace. It's just commonplace that you're building a product for everyone. You're not building a product for one type of person. Yeah.
I love that. So one of the questions here is that what's the current appetite for angel syndicates to fund first check? So maybe you could talk a little bit about what stage you invest in and the types of companies in terms of stage and progress syndicate members might see through your syndicate.
The deal flow that we have queued up right now is pretty diverse, honestly, in its representation, right? So we've been around in the ecosystem for long enough that we get favors that maybe other syndicate managers don't have an opportunity for. So I can't name the company yet because we don't have the deal for you guys, but there's a pretty hot company doing an 8 million seed round right now. That is part of flip up to the US. We can probably get a pretty good allocation on that, and that's pretty atypical. Our Hola Health deal, again, was pretty atypical, a pretty big check, a pretty fast growing company though. And so I think most of the time you're going to see us looking for an allocation of 100 or 200K, something around about the 3 to 5 mil kind of pre-money range, often is safe. And we think because we're focusing on a lot on who's building the product and how, we're pretty comfortable getting started sort of at the minimum lovable product, with maybe some early pilot customers, a little bit of growth on that, or maybe just getting started with some really positive interest from customers. So sort of pre-seed and onwards.
Yeah, we usually try to come in really early as possible. Even the Hola Health deal that we just did that some of you may have seen around about in the press was a bigger check for us. Depends on the appetite of who we have in the syndicate. That was a deal by deal basis as well. So it's appetite, and it's also our relationship with those founders and what allocation we can get as well. So I was really fortunate with that deal that I was able to bring that to Mate Ventures. I was a early check-in to the company myself personally. So there's quite a few things like that happen that we may have seen something and just be in it ourselves or be advising the company or whatever, and then it turns out that it's a really, really good deal for the syndicate. So we're always looking we're always looking. As Al mentioned, we've got one at the moment, which is around about that 8 mil mark. Another one probably around the 2 or 3. Holla was a lot bigger. So it's just so varied, and we're just looking for those really good teams and really good products. And maybe
we don't just
sorry. Yeah, you go for it.
Sorry, and we don't just hang around the Sydney and Melbourne ecosystem either. I think for a lean team, we go pretty wide. We're both in Adelaide, Brisbane, regional New South Wales, quite a lot. I think that we have a deal coming up pretty soon now, possibly our first deal, which is Canberra based. So we also have quite a bit of interest and connection to the startup community in New Zealand, which is like, in terms of valuation, Silicon Valley is to Sydney what Sydney is to the New Zealand startup ecosystem. They're really affordable companies. They're all global from day one because they don't have a domestic market. They're very coachable and very highly skilled. So we're hoping to bring you deals that you perhaps won't see just by hanging out in another angel group.
And how many do you think syndicate members can expect per year? Like, how many are you going to do? Maybe talk a bit about it, like logistics of what's the minimum check size to get in per deal? How many can they expect? Any other requirements?
Yeah, do you want me to start, Al, and then you can take it? So basically, I'm hesitant to say how many a year, but it's because the range is quite large that I've created. Between 12 and 20 is somewhere around what we're looking at doing. The minimum investment I I think we both sort of toyed around with a lot in our heads around what is, because as I sort of said to you before, and what I hope has become very obvious, is that diversity for us, outside of your usual people that continue getting invested and can continue investing, means that our minimum check size, we have created it to be quite small, so it's 2.5K in that you would need to invest in a deal, and so that is on the lower end, just so that people who do want to get started, people who do want to have access to just start, as Al said, you just have to start. And so how do you start if you don't have $20,000 to put into one company, which we've been fortunate enough to be able to do, as angels, for instance. But it's only, as I said, investing is a privilege. So let's let's knock down some more barriers, like, as much as we possibly can. I mean, I know the wholesale investor certificate, which I know you're very passionate about as well, Cheryl, because you're very vocal about it. I know that, and Al and I are as well, and that's a hurdle that we all know is there. But it is yes, and it's an extremely small, but what we see, to be honest, I haven't seen anyone put in something that small. I mean, this is prior to using Aussie Angels, but we have always been quite flexible with our check sizes, and our LP base sort of was sitting quite a bit above that, but we want investing to be for everyone.
Yeah, putting my forecasting hat on, I think we'll see over time that more and more angel investors will qualify as sophisticated investors through the knowledge pathway, right? So people aren't necessarily qualifying on income or size of assets, but because they've sat a test, studied and sat a test. I think we'll see lots of progress in that area. I know Cheryl lobbies hard for that, and I'm very happy to speak publicly about it as well. I think this needs to be an asset class that more Australians can invest in, and I think the winds of change are blowing Australia in that direction. So I think it's important for us to cater to that part of the market, because I think that helps the nation grow, and it's just I don't want this to be elitist. I don't want this to be exclusive. It's part of making the world a better place thing. So yeah, we'll try and keep the minimums as low as we can. Some of our deals will be big deals, and they will have high minimums. But yeah, we're going to tailor it every time to include as many of you as we possibly can.
Yeah, definitely.
And any other requirements to join, other than the wholesale status, obviously, but just touch on, like, what do you expect from investors if they do join the syndicate? And I think there's also another question up here that I'll maybe throw into this batch was, if we join and invest alongside you, what can we hope to learn the most about?
Cool. So first of all, primary requirement for joining the syndicate is that you not be a dickhead. If there's somebody who can stand in for you, if you find that you are a dickhead, that would be best, probably, because we would like this to be a lean-in community. Now, this isn't a full-time job for any of us except Cheryl and Emily and I. And so, we have to be able to build a community that allows you to lean in and then lean back out, because you've got other things going on that you need to attend to. So, if this isn't already clear, there is no obligation to invest in any deal to be a member of our syndicate. And we will be immensely grateful if there are times, if you've got special skills or special experience, which are helpful to a company that we're working with, and that we would love it if you can spare some time to lean in and give some help to those people. We would love you to not be, directive when you're giving advice. So it would be fantastic to have advice for our startup founders, which is, well, here's like 3 ways you could go with this. rather than you must do this one thing. Because remembering that we can all be wrong, no matter how much experience that we have. Literally my very first venture investment was one that I had passed on 3 months previously and turned out to be so far one of my best performing investments. So
Was that Canva?
we can oh, it was a company beginning with C, second letter A.
I like
For
to
very
tell
valid
that
reasons at
story.
the time.
I tell that story all the time.
You're free to. I'm pretty public about it, I think. For those who haven't heard the story before, the first time I invested in somebody else's venture capital fund was Blackbird Ventures' famous 2012 fund. And their very first investment was in Canva. And I wrote a pretty scathing email in reply to Nikki Shivak's investment memos. When they wrote to us all saying that they had invested in Canva, I wrote back and said, dude, what are you doing? Could you not just check in with me when you're looking at things? Because maybe I've seen that company before, maybe I passed on it like I did on Canva, and just a bit hurt. And of course, I had to eat humble pie. So yeah, none of us are right all the time. Right?
I'm so curious. What did he reply back to you? Like, you're wrong, mate?
It was something around the lines of he gave me a call. He was smart enough to not to buy via email, but I remember the call, and he said, well, we're going to have to agree to disagree, and that of course, when you looked at the deal, Cameron Adams hadn't yet signed on, and they didn't mention to you that he was considering an offer from them. But I knew Cameron, I knew he was capable of some great coding, but it seemed like he had a pretty comfortable job that made him happy at Google at the time. And I didn't think it was even, up for offer. But, two non-technical founders pitching to you that they want to build Photoshop but in a web browser, it didn't seem like a good bet in Australia at that time. There just wasn't a lot of great software engineering talent to recruit. So they got the one guy and it worked. And that's awesome. We all win.
That's hilarious.
We have a couple of other questions here from John. You're looking for the long-term return multiple. So there's two kind of exit paths for what we want to do. And one of those is the one that we all love to read about in the paper when there's an acquisition or an IPO. And those multiples, we kind of go along for the ride with those, right? If we get to that point, then the market determines what sort of multiple we see from that. Once a company lists on a stock exchange, it's up to the punters out there. The other kind of return that we expect to come from the fund are opportunities to exit at a secondary event. As I said before, the share some of my stake in Canva that went through Blackbird 2012 fund, I was able to exit and sell even though Canva hasn't been acquired and it hasn't IPO'd. So incoming investors buying at a higher price to us can offer to also buy our shares as well as the new shares issued by the company. And so that happens quite a bit and it's often not reported. So the big ones like the Canva secondary do get in the press. The smaller ones are generally kept confidential because you don't want to send a negative signal to the market. It's usually founders, early employees, and early investors in that company, and that's where we come in. So every deal you have to kind of look at, on its own terms. But generally speaking, Emily and I would be interested in an opportunity to discuss exiting at a secondary event, either wholly or partially, if we see an opportunity to get out at a 10x or greater return.
And I know you're asking about the multiple, sort of in the IRR point of
Emily.
Yeah. Oh,
we can't necessarily promise
it.
any type of IRR or like actual multiples. So you can say like
Oops.
what your I was like, I just wanted to stop you before you give a specific number.
Yeah.
But you can talk generally about like maybe very broad ranges.
Yeah, I don't really have a number anyway.
Okay.
But it is difficult, I think, to say and to obviously give out, and that's why we obviously have to be careful about it as well. But we personally have really if you want to chat to us about our angel portfolios, we are happy to discuss sort of how they look and all good.
I'll add some disclaimers. This is not financial advice, and past performance is not indicative of future performance, and this is not a financial product. This is all compliance stuff. Apologies, people, but you're welcome to talk to them individually about their experiences in investing so far. Cool, John, appreciate that, John. Sorry, we just have to, ASIC, and we're recording. So if anyone else has any other questions, we do have one from Stephen. I know you kind of addressed it there, Emily. Maybe expand a little bit on like how you'd like to work with LPs, and how maybe you can talk about that example that you mentioned.
Yeah, so the question from Stephen was, do you look for advisors / board members outside of your LP investor pool? And I said yes. I have one working with one of our companies in our portfolio right now, actually. This is right now just done through our networks, right? So it's just people we know, or someone who said, oh, this person's really good at this, you should talk to them, and it's all conversational whilst we're talking about maybe a particular growth area that someone in the portfolio needs and things like that. The next thing that Al and I are looking at doing is having a Slack community, and that will be where it will be, of course, it will be all of the LPs, investors, anyone who's actually joined the syndicate. Doesn't mean you have to invest. Anyone who's joined the syndicate, and then we will also most likely have within that community as well people who may not be in a position to invest or want to invest, but we will actually have advisors and people like that. So yeah, there you go. There's the sort of Slack community that's coming along, and that's what we'll be doing. And from there, you can kind of see where we may just slot advisors in and out. Basically, if there's something particular that you're really good at and we really need, it's a really nice fit. And so we find out through the community.
Amazing. Well, we will probably wrap it up there unless anyone else has any other questions, or if there's anything that I haven't asked you today that you want to touch on.
My goodness.
Nope. We've touched on a lot. We went through a lot today. I think I learned some stuff. I got a great story, got the kind of the follow-up piece of what happened after that email, Alan. So that's hilarious. Cool. Well, we will leave it at that. Thank you so much, everyone, for joining us. Thank you, Alan and Emily. It's been amazing, and looking forward to seeing deals come through. For everyone else, please make sure that you join the syndicate. Otherwise, you won't get to see those deals.
Thank you.
Thank you, everyone.
Bye,
everyone.
Thanks.